Ever watch someone, brag about some huge stock market win only to see them completely wiped out later?
Oh, yeah. The classic boom and bust personal story.
Exactly. Or maybe you've just felt that kind of nagging worry that your own investments, maybe they're more luck than actual strategy.
That tension is real. Fleeting gains versus building real, lasting wealth.
That's precisely what we're diving into today. I'm Lee. I'm the writer behind bullishbooks.com. And this deep dive, well, it's inspired by an article I recently published there.
And I'm here to help unpack some of those core ideas. It's really about trying to separate the signal from all the noise out there, right?
Yeah.
Understanding what actually drives long-term success in investing versus just getting swept up in whatever's trending.
Right. In my article, it's called How Not to Lose Money in the Stock Market. Essential Wisdom from the Intelligent Investor. You can find it on bullishbooks.com. I really wanted to get to the heart of Benjamin Graham's, timeless advice.
Such a foundational text.
It really is. So our mission today is to distill those key principles, make them super clear, and hopefully give you some practical steps to navigate the market more safely, more effectively, avoid those common pitfalls that destroy wealth and actually build something sustainable.
So less like the roller coaster of trying to time things perfectly, like Nicholas Darvis tried or that whole GameStop frenzy we saw.
Exactly. Forget
Yeah.
that stuff. We're going deep into Graham's value investing philosophy.
Mm.
It's all about logic, analysis, and aiming for long-term success.
Okay, so one thing that struck me right away in your article, Lay, was how you tackled the word investor itself. It gets thrown around so much, doesn't it?
Oh, it's everywhere. I mean, I've literally heard salespeople call buying a new suit or even a gaming console an investment.
Right.
And that same kind of loose thinking, it bleeds into the stock market. Anyone who buys a share for basically any reason suddenly gets called an investor. But Graham draws a really firm line.
Okay. What's his definition then?
For him, real investing has two absolutely crucial parts. One, adequate returns. And two, the preservation of your capital. That "and" is doing a lot of work there.
So it's not just about making money.
Not at all. It's making money while actively protecting what you already have. And that protection comes from thorough analysis, from actually understanding what you're buying.
And speculation is the opposite.
Pretty much. Speculation is trading without that solid foundation. It's chasing trends. It's FOMO, fear of missing out. It's taking on risks you might not fully grasp. The goal is often a quick buck, without much thought to the potential downside.
That GameStop situation back in early 2021, that's a perfect, if painful, example, right?
Textbook case. Some people made a fortune, sure, but many, many more who jumped in late, caught up in the hype, they suffered devastating losses. That's the speculative roller coaster.
And your article mentions Graham's suggestion about speculation. He didn't completely forbid it, did he?
No, he was realistic. He basically said, look, if you feel the urge to speculate, fine, but wall it off. Keep it to a small, clearly defined part of your money, maybe like 10%, and treat it completely separately from your serious long-term investment.
Kind of like your play money account.
Exactly. Recognize it's a gamble, not a strategy for actually building wealth. So if you're listening, it's worth taking a second to really think. Is your current approach based on solid analysis, or are you maybe chasing the next hot tip a bit too much?
Which leads us nicely into the next point you cover. The difference between defensive and aggressive investing. Now, aggressive sounds like more risk, but that's not quite Graham's take, is it?
Not really, no. Defensive investing at its core is all about protecting your capital. Job number one is loss avoidance.
Okay.
Graham's classic approach, which is still very relevant, involves a balance, usually high-quality bonds and leading common stocks. A 50-50 split is often the starting point.
But it's flexible.
Yeah, as I talked about in the article, depending on your view of the market and your own risk tolerance, you might adjust that. Maybe 25% stocks, 75% bonds if you're feeling cautious, or the other way around, 75% stocks, 25% bonds if you're aiming for a bit more growth. But the focus is always on balance and quality.
And it's really important, right, to have realistic expectations with the defensive approach. Your article points out it's not about trying to beat the market.
Just definitely not. In fact, you highlight that many professional fund managers struggle just to match the market averages, like the S&P 500, year after year. The goal here is steady, reliable returns combined with strong capital preservation, not shooting the lights out.
So what are some practical things a defensive investor can actually do?
Well, focus on established companies.
Yeah.
Big names with long track records of solid performance, strong financials. or reputable investment funds that hold those kinds of companies.
Makes sense. Due diligence on the fund itself, too, presumably.
Oh, absolutely. And maybe getting advice from a trustworthy investment advisor can be helpful. And then there's a technique I personally use and really believe in: dollar cost averaging.
Ah, yes. Explain that briefly.
Sure. It just means investing a fixed amount of money at regular intervals, like, say, every month, no matter what the stock price is doing.
So you buy more shares when prices are low.
Exactly. And fewer shares when prices are high. It takes the emotion out of it, smooths out your purchase prices over time, and can really help your long-term returns. It enforces discipline.
Okay, so that's defensive. Now let's flip to the aggressive, or as Graham termed it, the enterprising investor. As you explained it, Lay, this isn't about recklessness, right?
Not at all. It's about being willing and able to put in significant time and effort, serious effort, to try and achieve better than average results.
So doing the hard work of analysis.
Precisely. Deep dives into individual companies, understanding their businesses inside and out. It's not really about age either, despite what you sometimes hear.
Yeah, the whole young people should take more risk idea.
Right. It's more about your knowledge, your commitment to research, your analytical skill. But here's the kicker, and it's a big one. Consistently beating the market is incredibly difficult.
Most people who try don't succeed.
That's the reality. Many who put in considerable effort still end up underperforming the simple market averages. So unless you are genuinely confident and honest with yourself that you can add, let's say, at least 5% per year above market returns through your own skill, well, the defensive approach might actually be the smarter, better risk-adjusted path for most folks.
Okay, let's shift gears a bit. Your article also tackles something always on investors' minds: inflation. How does a defensive investor protect themselves from that gradual erosion of purchasing power?
Yeah, inflation. And
Yeah.
it's like a leaky bucket for your wealth. As I pointed out in the article, even a seemingly low inflation rate, like 2.6%, means $100,000 in income loses $2,600 buying power every single year.
Yeah.
Exactly. Now, historically, stocks have tended to offer better inflation protection than bonds over the long haul. But, and it's a big but, there are definitely periods where even stocks don't keep up.
So sticking to that balanced approach is key again.
Absolutely crucial for the defensive investor. Avoid going all in on stocks or all in on bonds. That balance provides some resilience.
You mentioned some specific tools, too, beyond just stocks and bonds.
Right. Some people look to gold, but honestly, storing and insuring physical gold can be a real pain.
Yeah, practical hurdles.
Fortunately, today we have more accessible options. Things like REITs, real estate investment trusts, those are companies owning income-producing properties, and TIPS, Treasury inflation-protected securities.
Government bonds linked to inflation.
Correct. The principal value adjusts with inflation. There are also bond funds that specialize in these inflation-protected securities. And this is important, they aren't magic bullets. You still have to look at the price. Are they good value when you buy them?
Nothing's a guaranteed win.
Never. And with TIPS, there's a quirky tax thing to be aware of: the inflation adjustment that increases the bond's value. That increase is considered taxable income in the year it happens, even though you haven't sold the bond or received any cash yet.
Huh. Good to know. Phantom income.
Yeah, something to keep in mind.
Okay, besides inflation, the other big unavoidable thing is market fluctuation. JP Morgan's famous line comes to mind.
It will fluctuate.
Yeah.
So simple, so true. The market goes up, it goes down. It's unpredictable in the short term.
So how does a defensive investor deal with that uncertainty? You listed some don'ts in your article.
Yeah, some key things to avoid. Definitely don't buy securities on margin. That's borrowing money to invest. It juices potential gains, sure, but it magnifies losses massively. Very dangerous.
Leveraged risk.
Exactly. Also, resist the urge to try and pick the next big winner or perfectly time the market, buying low, selling high consistently. It's practically impossible for most people, even the pros.
So no crystal balls.
None that work reliably. And steer clear of those overly simple, formula-based trading systems that promise guaranteed profits. If they really work, believe me, everyone would be rich from them already.
Fair point. So what about the do's? How do you navigate the fluctuations positively?
Well, regularly rebalancing your portfolio is key. That means bringing your stock and bond percentages back to your target levels. Say you aim for 60-40 stocks bonds and stocks have soared, making it 70-30. You'd sell some stocks and buy bonds to get back to 60-40.
And that decision should be based on analysis, not just random.
Absolutely. It should be part of your long-term strategy, based on your assessment of market conditions and your goals, not just on a whim. Also, you have to accept that even the best quality stocks will have price swings. sometimes big ones. The market is emotional.
Don't panic sell good companies just because the price dips.
Precisely. Instead, look for opportunities to buy good companies when they're trading at reasonable valuations. Consider their assets, their earnings, their financial strength, their history of profitability.
And avoid the junk.
Generally, yes. Defensive investors should usually steer clear of low-quality bonds, most preferred stocks, and convertible securities, unless you can get them at a really significant discount to their actual worth, because they often carry hidden risks.
Now, you also really hammered home the point about not overpaying, even for great companies. That's central to Graham's philosophy, isn't it?
Absolutely critical. You could buy the best company in the world, but if you pay way too much for its stock, you might still end up with a terrible investment return for years, maybe even decades.
You had some starry examples in the article.
Yeah, history is littered with them. Think about the 1929 crash. It took about 25 years for the market to fully recover its peak value. Or the dot-com bubble around 2000. Some of those high-flying tech stocks. Well, investors who bought at the top might still be waiting to break even decades later.
Wow.
Graham's core idea here is that you make your money or lose it when you buy. The price you pay determines your margin of safety. Pay too high a price, and you have no safety net if things go wrong or sentiment changes.
And he gave defensive investors some pretty specific rules or criteria for selecting stocks, didn't he? To help avoid overpaying and ensure quality.
He did. Really practical, time-tested guidelines. First, adequate diversification, but don't overdo it. Spread your risk across different industries.
Don't put all your eggs in one basket.
Exactly. Second, focus on large, prominent companies, industry leaders, companies that are conservatively financed, meaning they don't have excessive debt.
Financial stability.
Right. Third, look for a long history of continuous dividend payments. Graham suggested at least 10 years. That shows stability and profitability and makes you question management if they always say they need to keep every penny for growth instead of rewarding shareholders.
Good point. What else?
Check the balance sheet. He wanted current assets like cash, receivables, to be at least double the current liabilities, short-term debts. And also, total long-term debt shouldn't be more than the company's net current assets. Basically, a strong financial cushion.
Makes sense. And earnings.
Stable earnings growth. He looked for at least a 30% total increase over the past decade, using 3-year averages at the beginning and end to smooth things out. Yeah. Not spectacular growth, necessarily, but consistent progress.
And finally, the price itself, the PE ratio.
Yeah, the price-to-earnings ratio. He put limits on it. No more than 25 times the average earnings of the past 7 years, and no more than 20 times the earnings of the last 12 months.
That probably rules out a lot of popular growth stocks today.
Oh, absolutely. His criteria are quite strict by today's standards, especially for growth stocks. It really biases the selection towards established, consistently profitable companies selling at reasonable prices. And even after all that careful selection, he still recommended using dollar-cost averaging when buying.
So, layering safety upon safety.
That's the idea.
Okay, so as you wrap things up in your article on bullishbooks.com, Leon, the world's changed a lot since Graham wrote his book. I mean, we have online trading, super low fees, tons of information, ETFs.
Everything's faster, cheaper, easier in many ways. Things Graham couldn't have dreamed of.
So what's the big takeaway from all this Graham wisdom for investors navigating today's market?
It's that the fundamental principles haven't changed. They're absolutely still vital. Those stock selection criteria we just talked about. You can use that same thinking to evaluate the kinds of companies held within the mutual funds or ETFs you might be considering.
So look under the hood of the fund.
Exactly. Just because a fund exists, or it's popular, doesn't automatically make it a good investment, especially at any given price. You still need to consider value. Ultimately, Graham's core insights on managing risk, on doing your homework with fundamental analysis, and maybe most importantly, understanding the psychological traps that trip up investors. That stuff is timeless.
It's about behavior as much as numbers.
Yes, definitely. You know that famous quote from the philosopher George Santayana? Those who do not remember the past are condemned to repeat it. Well, in the stock market, forgetting those hard-learned lessons from past bubbles and crashes, that can be a very, very expensive mistake.
So, let's boil it down. As we finish this deep dive, what are the absolute key things you want listeners to take away from Graham's principles from our chat today?
Okay, key takeaways. First, really get the difference between investing based on analysis and just speculating, and be honest with yourself about which camp you're in.
Self-awareness first.
Second, understand defensive investing. Prioritize protecting your capital. Diversify across high-quality assets. Third, remember inflation. It's real. Look into sensible ways to protect your purchasing power, but choose those tools carefully.
Okay.
Fourth, accept market volatility. Ups and downs will happen. Build a strategy that lets you ride them out without panicking or making rash moves. And finally, maybe the biggest one, don't overpay. The price you pay for any investment is absolutely critical to your eventual success.
Solid advice. And if someone's listening and thinking, okay, I want to start applying this, what's a good first step?
I'd say take a really hard, objective look at your own portfolio right now. Your current holdings, your strategy. View them through this Graham lens. Are you genuinely investing based on value? Or maybe speculating more than you thought? Are you diversified enough? Did you consider the price you paid?
A personal portfolio audit.
Exactly. It's a super valuable exercise. And look, if you found this discussion helpful, I'd really encourage you to visit bullishbooks.com. You can read the full article we've been talking about, plus find other resources on value investing, risk management, things like that.
And subscribe for updates.
Yeah, absolutely. I'd love for you to subscribe to the newsletter to get the latest insights and analysis delivered right to you.
Great. So, a final thought for everyone listening. As you think about your financial future, really consider this. Are you building a sturdy foundation for long-term wealth, something resilient? Or are you maybe just chasing quick, potentially fleeting gains? That peace of mind that comes from knowing you have a sound, value-based strategy, honestly, that's often the most valuable return you can get.